Hi, my name is Darren from HCJ.tax, and we're the team that seeks to demystify that sometimes confusing world of international tax. And today we have the honor and privilege of speaking with George. George, can you please introduce yourself?
Thank you, Darren. My name is George Dimoff. I'm a certified public accountant, and I have a team of 14 senior professionals. And what we do is the same type of thing: demystify taxes as much as possible, and with a focus in international and typically complex situations.
Fantastic.
George, let's talk about revocable and irrevocable trusts and the issues that arise in transferring assets into a trust. Can you talk about that?
Of course, when you have a trust structure, usually there's assets that are looking to be protected. And when you have really a truly high net worth family, you're probably going to use a combination of both. And some common things to just keep in mind on a revocable versus an irrevocable trust is control. In a revocable trust, the grantor retains full control. In an irrevocable trust, the control is relinquished to the trustee. And so a revocable gives you a lot more flexibility, but the irrevocable one is where people put really the most amount of assets that they expect are going to appreciate and value the most. And that's where a lot of your tax planning and strategy come in. For instance, if you have, let's say, a business that is worth $5 million, well, that's under your lifetime exemption, right? Your lifetime exemption for estate tax purposes is now somewhere around 13 million, right? Let's say you take a $5 million business and you put it there. Okay, you're that 5 million is reducing your lifetime exemption. Okay, but if that business worth 5 million ends up being worth 30 million or 100 million at the time that you pass away and your beneficiaries inherit it, that's where the real tax break comes in, because you've locked in that value in terms of your estate exemption. So most people use kind of a combination of these, revocable and irrevocable. So for revocable, it'll hold your main residence, checking account, brokerage. It's the whole point of the revocable trust. The benefit is making it very easy when the person passes away to avoid probate and avoid tons of complexities and make it easy for the beneficiaries to take control. But again, the irrevocable trust is going to be where you hold your life insurance, your business shares for the company that you own, your private investments, and that's the one that's used for tax minimization and asset protection. So those are your main differences. And we have a team at my company that specializes specifically in trusts. I do have a tax attorney on the team as well that will help review these type of documents and provide advisory. And then I do have two other staff members that specialize in exactly this: trust, tax, savings. So it's something that we do every day.
Fantastic. So, tax optimization, asset protection, succession planning, probate avoidance. It sounds like this is something that you guys do all the time. Your typical clients are like mixed families in and out of the US, or US residents only, or?
That's a great question, and I appreciate you asking that. We tend to attract a lot of international. I mean, even my name, when you see it's a foreign name. I'm from another country, and we tend to attract tons of international clients. And we get many young families here in the United States that are coming in on J-type visas, H-1B type visas, TN visas from Canada or Mexico. I mean, we see so many of these, and many that are coming in on student visas and then transition to a different type of working visa after. So we get so many of these situations where, I'll give you an example. A young family comes in, one is from India and she gets a job at, let's say, Google. And we have so many people that work at the technology companies that are coming in for engineering career paths. And then they bring in the family and they have all of the associated issues that come up in these types of situations. We're married in India, but we're not married in the US. Do we file our returns jointly? Do we file them separately? What money is reported in terms of our income on the return? Should I include my husband, who's only been working in India to date and is coming here basically as on a family visa, or do I only include my income? How do I report my assets that are still in India? And I'm using India as an example because it's a very common country for people to move from, and we have many clients from there. So these are all the types of issues that come up, and we see this absolutely all the time.
Fantastic. Thank you.
George, if someone wants to get in touch with you, what's the best way to do that?
My website is a great way. You can go on our website, which is Dimoff Tax. That's my last name. That's EIMOV tax.com. Or you can send an email directly at info@dimoftax.com. Those are two great ways to get in touch with us. We also have a phone number. You can also call us. And the best phone number is 833-829-1120. That's +1 833 829 1120.
Fantastic. Thank you.